Hello and welcome to Weekend Wisdom. Today, we're going to talk about bonds. Boy, does that sound like an exciting topic. But seriously, for the first time in years, we're seeing some losses in bonds, and that is a concern. So sit back, grab your cup of coffee, and let's get started. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget you can click Show More for additional information and links on today's video. Also, if you're looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing. So today, we're going to talk about bonds. Look at the excitement I have. Well, yes, bonds are not the most exciting asset class, but they are, in a lot of cases, a key component to one's overall allocation. But this year's been a little bit different because of the change in rates. What do I mean by that? Well, rates work inversely, of course. So as rates go up, prices go down. So for the first time in quite some time, we are seeing some losses on the bond side of our portfolio. So what are bonds? Not going to get into a big speech on this one, but those who know, very simply, you're going to give a company money or the government or a municipality, and they're going to give you a payment back. And that payment is going to be based on risk, and we'll talk about that in a second, and also duration. Pretty simple, and then you get your money back at the end of that term. So why are bonds so important to one's portfolio? We work with mostly retirees, although we have a really growing 50 to 60 crowd. But bonds are a part of the portfolio you look for to have a risk-off piece of a portfolio. So in a 60-40, 40% risk-off, 60 in equities, we use that for risk. But this year, we're seeing a lot of volatility, and then we're seeing some losses on our bond portfolios, which can potentially hurt your overall performance. We've been very spoiled over time. What do I mean by that? Well, let's go back to the 10-year Treasury here, back to the 80s, and we had a whopping 18% yield, which was awesome if you own bonds giving you 18%, not so much if you had a mortgage. But as you look at this chart, I'm going backwards here, I'm looking here, and I don't know where it's going to show up, but when you look at it, it's going the other direction, right? Top 18% down to the low 2s. So again, yield down, price up. It has been the longest bull market in history, and let me tell you, it was a stampede. What a great way to make money without as much risk. But now the trends have changed. We know that we're in a rising interest rate environment. Now, there's a difference between rising rates with the Fed and bonds, but we are seeing this shift. And here in this chart, you can see we bottomed out in September of 2017, 2.05, and we're at 3.22 as of this recording on the 10-year Treasury. So opposite way, right? Rates up, price down. That is not a good thing. So what exactly does that look like? Here's a quick piece here that shows you the difference on a 1% move on a bond and the impact on actual losses. And as you can see here, the further you go out on the curve, so from 2-year to 30-year, is the greater loss. So in a 10-year, you're looking at somewhere in the range of 8%. On a 30-year, you're looking at 17 to 20%, depending on the period. That's significant. So you're buying a bond for safety, and you can see losses And then I show some other asset classes, not just treasuries, but convertibles, floating rate, again, TIPS, MBS, and of course you have emerging markets. There's all kinds of debt out there. So this is why we have to be careful, and here is a year-to-date chart. It shows you, and right down the middle are what? Losses. Of course, again, what I'm trying to say here, we don't want to see those losses in a bond portfolio. Now here's the big picture of bonds going back the last 10 years, and you can see right in the middle is asset allocation. And even if you were diversified amongst these various bond sectors, you've done pretty well, except on a couple years. And there's always been a sector that's done very well, but this year you have high yield and going down, everyone else is seeing losses. It's going to be an issue. So what do we do about bonds? Well, one is buy individual bonds and then just hold that, get your money back. But again, you're going to see price fluctuations. Now, in that scenario, I would ladder bonds. Again, I'm not going to get into that. Knowing that rates are going up, you don't want to lock yourself in too long. So buy a series of bonds that are coming due every 2 to 5 years and get a higher piece of paper as you go forward. The next one is stay short. Short duration. If you go back to that one slide with performance, the longer out, the bigger the losses. Here's a look right now of from 6 month, 1 year, 2 year, 5 year on the way out. Straight up, but you're getting some pretty good rates right now. CD rates are going up, money market rates, short duration. I mean, I've seen some short duration funds out there that are getting upwards of 2.5%. That's a nice yield if you're looking to park cash right now. So the shorter you are, the better. The next thing is go outside the normal spectrum. Again, we know about treasuries, corporates, okay? You have to look at some other areas, floating rate, MBS, high yield, but let's be careful there, folks. I'll do a video on that one later. We're hearing a lot of stories as rates do go up. High yield is going to go, yes, you might see a higher return, but that's because the credit quality is going down. So we want to be careful with high yield going forward. So what's my conclusion? What should we do about bonds? Well, first off, let's be patient. I feel we may have topped off on bonds. A lot of other folks say that. So if we get one more push to the downside, and if we continue into this type of volatility, historically we've seen a flight to quality where people will go into bonds. That might bring down bond yields a little bit. Again, yields down, price up. So I think let's be patient a little bit before we do anything outside the box. And then from all the other items we talked about, be tactical. Look around, make sure you're ready to go. Be smart with that. Work with an advisor. This is what we do every day to make sure that you're in the right places. And just like I talk about with equities, stay nimble, as always, folks. Thanks so much for watching. Michael Loftus for Wealth and Wisdom TV.